what I'm hearing from you is not about getting the biggest check. It's about, there's a philosophical thing going on in your head about what is optimal. And there's probably some legacy stuff built into that. I'm hearing, some sense of responsibility for your people. All those things do kind of push you towards an ESOP because of the fact that it does accomplish a lot of those goals, right? So it's a wonderfully graceful way to exit a company, right? But again, do we want to exit, right? We don't have to. So some people look at this, like I said before, as a chips off the table transaction, and sometimes they don't even need the money.
I reject this idea that businesses were built to be sold, but for ESOPs, I think ESOPs are awesome. So I guess what I want to just, I think I told you I've taken like 60 calls from the private equity guys, and each one less original than the last, it seems. And I don't mean to be condescending, but I don't. My people are extremely like, please never sell. We don't want to work for those people. I've seen the effects of it. And so I view this as an epic alternative. Anytime I see a company that is employee owned, they get it, right? I think they're living out their purpose, and I think it's just a better means to do business. And so I recognize that saying that publicly is going to get me shamed. So I suppose my question to you would be, who shouldn't be thinking about ESOPing, and why then? And also, who shouldn't be, and why wouldn't I guess?
Yeah,
Like,
it's a
let's play
good
red
question.
team.
Good question. So let me give you two scenarios, right? And these are two live client situations we went through last year, where one did an ESOP and one did something else. Let's just say a third party sale. So first scenario was they were both actually in the same region, both in the same industry, right? So very similar, and actually relatively similar from a size perspective. So scenario one, you've got ownership that could have sold to private equity, or strategic, whatever it may be, but they felt like, they were a 65-year-old company. I know, you kind of have a history too, so there's some common thread there. And they felt their next gen was up to the task, right, to take it to the next level. So they felt very comfortable, and I think there has to be, when you're considering selling your biggest asset, which for a lot of our clients, their company is, or we think being informed is also good, right? But regardless, they felt like they knew what the market was for private equity, as you probably do if you've taken 60 phone calls. You have a sense of what the market is, right? But they wanted the company to stay independent, and they felt very strongly about their next gen and their people, and they ultimately did an ESOP, right? So company number two was not a good fit for an ESOP, and they kind of knew it going in, but we had a conversation with them anyway to kind of figure out what was the best path, right? Because whatever you do, whether you sell the company, don't sell the company, sell to a third party, sell to an ESOP, sell internally, whatever the options are, you got to know what the options are first before you make a decision, I think, right? So anyway, I think due diligence in considering a sale of a multi-generational asset is very important. So this second company felt like they didn't have the next gen. They felt like it was a family-led business, second generation, and they felt like they'd taken it as far as it could go. And they felt like the right operator could do much better by the company. Now, there's also a financial element to this, right? So one of the things you see with a third-party sale versus an ESOP, oftentimes, not always, but oftentimes, when you're looking at the feasibility of a transaction, you can recognize more cash in the near term, potentially with a private equity or strategic sale, than you can with an ESOP, right? So I think some people look at it and from a time horizon perspective and a risk tolerance perspective will say, now is the time. I feel like, I've been doing this 30 or 40 years, whatever the runway is, and you get to know the market pretty well, I think, after seeing multiple cycles and running a business for a very long time. And sometimes it just feels like the time to get out, not because storms are coming, but maybe, the cycle is right. We're at the right kind of, cycle of the wave where, there's still some power left in it, but you haven't, it's not, you're not missing it, right? So I think that's a big deal too, where, an ESOP may not be a fit. So I think what we see is there's successful examples of all different kinds of ways to transition a business, but the big but is it's got to align with what's important to the stakeholders. And that's where ESOP oftentimes finds a really good home is, it really potentially, when done right, can be a good deal for everybody. But no one has to get left out in the cold. Does that make sense?
Yeah, and is there, I guess, yes. Why don't we talk about the mechanics so that I understand and then so everybody can understand? Because I mean, in my world, there's this, it's a fad. I don't know, I don't mean to say it that way, but this
Okay.
fad of like read Cody Sanchez's book, go buy a business, sell a business, like the greatest wealth transfer, all of that. And I'm like, there's this fad. Do the easy thing, get an SBA loan, buy a business. I think I'm at least one tier above that, maybe not,
Okay.
but I want to dig into the mechanics of all of it. So you said something, and I guess before I ask my specific questions, is there any generalizations that are thought of in ESOP land that don't apply that you'd like to eradicate? Like I've heard, like I've only had two people roll their eyes like, why would you ESOP it? And I'm like, yeah.
Yeah, that's a really good question. I think the biggest thing that people get wrong about ESOPs is that you have to take a discounted price to a third party sale. Sometimes that's true, right? So we're representing companies on a regular basis that are 100% employee owned that are trading at a certain multiple, right? Because we know what the multiple is because they get it every year from the trustee. They say, okay, well, your EBITDA was this and here's your value. So we know what the multiple is, right? What if the market for that company is 3 or 4 times higher in the open market than what you're trading at, right? So I think what we see is there are disconnects to the positive and to the negative, right? So some companies don't have as big of a market from the standpoint of private equity or strategic buyers, right? So you think about things that start to detract from the marketability of an asset, bonding, right? Union, right? Project-based work, right? Is this starting to sound familiar, right? So that starts to make it a little bit less interesting, and certain kinds of businesses aren't as attractive for outside investors, but are potentially very attractive for an ESOP buyer. So there really is some very interesting gaps in the market where it's rare that you're taking a huge discount to what the open market will pay, but there are times where you are. That absolutely does happen. But most of the time it's very close, if not a little bit better. The big, from a valuation perspective, the big difference is timing of cash, right? That's what I think, really makes a difference, right? So let me explain to you what all that means, right? So let's talk about a $10 million transaction, right? So let's say you sold your company for $10 million. Well, if you sell to a third party, right, you're going to have some taxes, right? So that $10 million becomes maybe $7 million, right? So let's just say you're paying 30% taxes, right? So you walk away with $7 million best case scenario. You probably have some kind of earn out or some kind of rollover component, which means maybe you're getting $5 or $6 out of that $10 million in actual walk away cash, right? So let's talk about an ESOP, right? So let's just say you can sell for the same $10 million, right? So you might only get $5 million up front, right? So that's the big delta, right? Is you may get 6 or 7 up front with the third party sale, but here's the big but. You're going to get another $5 million with the ESOP, and if you do it right, all of that money is tax free, right? So would you rather have $10 million or 6 or 7, right? Some people would say, yeah, but there's an extra $2 million in there potentially now. I don't want to wait. Other people will say, I'll take that bet any day of the week, right? Because I'm going to effectively bet on myself and the future of my company for another 3 or 4 years to get, significantly more net after tax proceeds. That's the big math equation with ESOPs.
Is it escrowed, or how does the cash, and how long is it escrowed, or what is the time horizon to get that full value?
Yeah, good question. So that gets into the mechanics of it. So let's just say the typical ESOP happens between, let's just say 5 and 7 times trailing 12 months EBITDA, right? So if we use kind of a round number, let's use 6 times, right? So let's say you agree to a deal for 6 times EBITDA for the sale of the company. Well, you've got to get some cash. You don't have to, but most people say, yeah, and I'd like some cash too with that, 100% sale, right? So where does the cash come from? Most companies will go to a bank and say, lend me some money in order to facilitate the buyout, right? Just like buying a car, buying a house, whatever it may be. You're borrowing against the company's creditworthiness to provide the financing. Well, nobody's going to lend you 6 times EBITDA, right? It's unlike, not at terms you'd be willing to borrow at, right? So the market is like 2 to 3 times. 3 times at the kind of the tip of the iceberg, and maybe more commonly 2 to 2.5 times EBITDA, right? So there's two choices there. You obviously only have, let's say at the best case scenario, you've got 3 times EBITDA on a 6 times deal. That's half your money, right? So on that same $10 million deal, right, we're getting 5 million of our cash up front, and we've got two choices with the balance of it, right? We can take back a seller note for the other 5 million, right? Or we can just sell 50% or 49% more commonly and hold back the rest of the equity for a future event. So those are kind of the big choices if you think about it structurally.
Got it. Okay. And so that makes sense.
Yeah, I think that's the biggest one is people think, I think there's this perception that they're going to just walk away with significantly less money because they did what's perceived as a good thing for their people. And, good things usually come with discounts or costs, right? They don't in this case.
And so the debt service on the, let's stay in hypothetical impossible land because I'm a simpleton and I'm hoping that my people are simpletons too. So $10 million, let's say they do write the whole thing. And so we've got debt service. Let's just say the debt service is 10%. How's that different in my environment than in because private equity is throwing debt at it anyway, right? So like,
yeah,
is it worse for the financials? So because
that's a good question. So here's the kind of the magic of it, right? So I told you about one of the tax benefits, right? Which is you potentially can avoid paying the capital gains tax. That's a big one, right? That's a personal benefit that the shareholders can take advantage of if they do an ESOP. There's also a corporate benefit in ESOPs that effectively makes the debt service very simple for most companies, right? So let's just say you're that $10 million company and let's say you're generating $2 million of EBITDA, right? Right. So you're going to pay some taxes, whether you're an S Corp or C Corp, somebody's going to pay some tax, right? So let's just say that tax is between 20 and 30% of your earnings, right? So, if you're talking about, $2 million of taxable income, there's hundreds of thousands of dollars of tax being paid every year. Well, in an ESOP setting, most companies will do a transaction as either a C Corp or an LLC. But most of the time we see C Corp transactions, right? So the company then gets a huge tax deduction because they did an ESOP, which they can use to effectively reduce, if not eliminate, corporate tax liability. So what did we just do? We just gave you that, let's call it $500,000 in tax, either the company or the shareholders were paying. We've now got $500,000 effectively in money to service the debt, right? So the first question that people ask is, well, how can I borrow $5 or $10 million and cash flow? Well, the answer is you're not going to be paying any corporate tax. You're not going to be paying any, distributions for tax to the shareholders, depending on your status. So now you've got more principal available to service the debt and pay back the money. That's a big difference because a private equity buyer, again, they're going to use a similar leverage profile, right? But the big difference is they don't have the tax benefits, right? So they've got other things, but you can potentially retire the debt a lot faster in an ESOP setting because you're not paying any taxes. So that's a big difference.
Are you guys into the one other, and I will dive into my real example, and I'm curious what your advice would be, and it's kind of interesting to just go unbridled online with it, but I think it's the most beneficial thing I have is my story. But are there oh my gosh, now I lost it. Oh, are you guys playing banker? I've heard, so I'm one of the guys I'm a big fan of, Herb. Like, he didn't use a bank or he self-funded, so I think he just did the whole thing as a seller's note. Are you guys, is FMI a bank option or you guys connect us to a bank?
Yeah, good question. Yeah, so the financing is not something that we provide, right? But we do assist companies in securing the financing. So just kind of high level on how the financing market works. Most of the time you're seeing regional banks or kind of super regional banks fund these transactions. That's the most common source of funding. So Truist would be an example, Citizens Bank, I'm trying to think of some in your region, Wintrust. You definitely see the Wells Fargos and the PNCs and the B of A's occasionally, but it tends to be these regional banks, and they tend to look at these loans from a cash flow perspective, which is a big element, right? So most of the time, as long as you kind of have a certain minimum threshold of profitability and critical mass, you're not signing anything on that loan personally, right? So it's a corporate obligation which is obviously a risk transfer thing, right? So if you borrow some money from a bank to finance your transaction, but you're personally guaranteeing that loan, you're kind of just taking money out of one pocket and put it in the other. It's still stuck at the bank. Still got it legally, right? So the financing element is important because most people, when they sell their company, want to receive some cash. Not everybody. It doesn't have to be, but one of the elements I think that's very important to consider when you're going through this is the tax deferral piece, right? We touched on that earlier. The ability of the sellers to avoid or not recognize the capital gains tax on the sale. Very impactful, obviously, but you've got to do some kind of an investment portfolio. And I don't want to get too far into the weeds on how that works, but you need some principal to do it. Otherwise, you have to pay the tax. Now, if you don't care about tax, then it's less impactful. But I would ask you the question, why are you doing an ESOP if you don't care that much about taxes? But it's not all about tax, right? Tax is a big element, but the tax is a really important piece that gives you some really interesting incentives to do these things, but it's got to be a right fit from people, values, goals and objectives, timelines, all those things also have to align for this to make any sense to you.
And is there a target size where ESOP makes sense? Is it when for you? I know you guys are dealing with the bigger fish, but what is generally the guidance for ESOPing or any of that? Is it the same as private? They're not really interested unless there's $2 million in EBITDA. Is that really the game?
I mean, it's not really about, I think, interest from the community, because I see companies that have $2 or $3 million of EBITDA do ESOPs all the time. It just becomes a little harder to finance them. So banks have, as the smaller the company is from an operating results perspective, the more risky the banks look at it. And then it just limits the market for cash, right? So that's not necessarily a bad thing, but for someone that's saying, hey, I want to be able to do a risk transfer type of transaction and take some real chips off the table, it's just a little bit hard to make the numbers work. And then I would say the other point is there are some fixed costs to do an ESOP. If you want, in my view, if you want to do it the right way, independent trustee with their own legal counsel, their own financial advisor, you have a lawyer, right? And that's before you get involved with the bank, right? So it could cost you, before you hire someone like FMI, $200,000 or $300,000 in professional fees to close the transaction. So there's a threshold level there where, hey, we want to do it right, but if it's 5 or 6 or 7% of the total deal just to get it done, it starts to become a little bit less attractive. But yet, long story short, $2-3 million of EBITDA. I would say, if you're looking for a more market, kind of deal that would compete with a private equity or a strategic type transaction, I would say $2 or $3 million of EBITDA is where it starts to make sense.
And then, is there any wisdom, or is it all preference? Percentages, right? Is it, you see 100% ESOP, you see 40? Do people do better when they retain control? Is there any wisdom in how much of it you sell back to the employees?
That's a really good question. So we do a lot of minority ESOPs, and there's a variety of reasons why. So I think a lot of it is timing, some of it is structure, some of it is mechanics of the variety of the dynamics that go into a transaction. But let me give you a couple examples, right? So we did a minority transaction for an electrical contractor last year. Two brothers owned 100% of the company, or not 100%, most of the company. And they really they weren't ready to sell, but they felt like they had some big goals, some charitable goals they wanted to accomplish, some personal needs, and it allowed them to really continue to operate their business almost the same as they were before, but get significant tax-free liquidity, right? So that was the motivation there. Chips off the table, right? We're not ready to completely exit, but we like to have some liquidity for other needs. That's very common. Sometimes it's a shareholder buyout, right? So you've got multiple shareholders in a group or an individual or a group of individuals wants to exit and the others want to stay, right? That's also a very common reason for a minority transaction. Different timelines, right? So there's lots of reasons why, and I don't think it's really as simple as, is there one path that's just better. I think if you were to just say, let's put these two deals on paper, right, and which one is going to pencil out better most of the time, it's going to be 100% sale, right? Because there are some additional benefits to doing it that way. It typically pencils out better. But if it doesn't meet your goals and it doesn't fit your objectives, who cares?
And if we were talking on behalf of or for the, like, I don't want to, the people that may think this doesn't apply to them. So I want to make sure this applies to them, right? So like, if you're not going to grow your company to being $2-3 million in EBITDA, or, but let's say you've got a healthy company that's generating somewhere between 300 and let's say say 300 to 1.2 million dollars in some type of earnings, questionable, all of that stuff. Is there a play to be made in this realm, somewhat of a bootlegged play, to give it to the next generation, an arm's length transaction where it is a ESOP, or is that really just a handshake deal from operator to next operator? Like, how does it work on the lower levels?
Yeah, that's a really good question. So what we see more commonly is a management buyout type structure in that setting. The other issue you run into with smaller companies is employee count, right? So as I'm sure you know, depending on the type of construction company, that there can be a huge variance in how many employees they have, right? So for example, we're working with a GC right now that's going to do 90 million in revenue this year. So not huge, but not insignificant either. They have about 30 people. The threshold to really kind of make this work from a regulatory perspective, because it's a qualified plan and you have to do testing and you got to comply just like a 401k plan, is about 20 to 25 people. And then when you've got union potentially involved as well, that we see companies that are of material size that have 10 or 12 employees that aren't union, that are W-2, that becomes an issue from a compliance perspective. So the smaller you get, the more these kind of issues start to arise where feasibility becomes more limited. Of an ESOP, right? So there is another option, right? So I like to say there's kind of three paths here. The first is kind of a management buyout structure where you can 100% pick and choose who gets the stock. You can decide when they get it, who the people are. It just doesn't come with all the tax bells and whistles that an ESOP comes with, number one. Number two, they're usually structured to be more closely held, right? So instead of having everybody that works for you be eligible, there's maybe 5 or 10 or maybe even less, right? So there's a whole host of structures. I would say in this industry, the construction industry, that's actually quite common, even for larger companies to do their ownership transitions through a management buyout, right? So pluses and minuses, right? So let's talk about it. Pluses, it's relatively affordable, right? Doesn't cost a lot of money. You don't have to pay, an investment banker and all these lawyers. You may need an attorney, draft some documents, but you could probably do that whole thing for a few $100,000 all in, right? Versus $700,000 or $800,000 maybe for an ESOP transaction, and maybe even less, right? So that's the upside. Is it's very feasible. It's relatively easy to get into. The downsides are it takes a long time, right? Even if you're only transitioning $4 or $5 million of equity value, most of the people that you transition to don't have that kind of money laying around. So there's either a phased approach, a note, or a new old co new co approach. There's a lot of different ways to do that transition, but typically doesn't come with a liquidity event either, right? So it's a long-term plan of liquidity. So those plans can take 7 to 10 years, sometimes longer. And if you think about it from a tax efficiency perspective, remember we talked about the two big tax benefits for the ESOP, right? The shareholder doesn't have to pay tax potentially, and the company gets this big tax deduction. You don't get either of those with a management buyout, right? So, and then the last point I would say is that when you're thinking about value spectrum, right? Most people think at the far end, you've got kind of that strategic who's willing to pay whatever they have to pay to get you. Right, then maybe you have private equity, and then ESOP is somewhere in the middle of the spectrum, fair market value concept, but maybe not synergistic or strategic premium. And then on the lower end, you have management buyouts, which are typically done at book value, right? So most people, when they think in terms of how a company might be valued, they look at book versus fair market. Fair market is usually a lot higher. And the reason why you can transition at fair market value instead of book with an ESOP in a similar or faster time horizon is the tax benefit, That's the big benefit. But, again, it's expensive. It takes some degree of critical mass. And it is something, I would say, I thought of a couple other things. You talked about, some reasons, misconceptions or why people don't or don't do these deals. Big one is debt, right? I would say maybe 10 to 20% of the people I have an initial conversation with tell me they don't like debt, right? Which is kind of a problem if you're going to do leverage buyout, right? So, I think you have to have some comfort level with, in doing an ESOP, and for private equity too, that the company is going to have to borrow some money to facilitate a transaction. That's absolutely a fact of life. Whether it's a seller note or a bank note or whatever it is, the company's going to have to borrow some money in order to facilitate a transition of ownership.
So you said three options. So you've got private market sale, ESOP, or management
Buyout. Yep.
Yeah, got it. Okay, very interesting. Okay, so now for anything we didn't hit. Otherwise, I'm going to dive into complete fence, and I just want you're completely fair, and I'm curious why you'd advise the way you would advise. So, so we grew, and I'm sorry if I've already told you this, but we grew too fast. So I made we bumbled from 5 to 50, and we'll be somewhere between 90 and 120 million this year top line. Bottom line should be improving. Like I would say last year we did probably 5 on 50, so we ran like a 10%. I think we'll do 50. We're budgeted for 15 on 90 in EBITDA this year.
Okay.
And I built this company for this day forward. My problem was I was way out in front of myself, like I knew what would happen. So I don't need them to tell me what we can do. Like I think we could hit $1 billion in 3 years, probably more responsible to do it in 5 years. And at today's mark, I need no more dollars. I've set my life up to be, I'm fine. So the difference in an exit or a partial exit it means nothing to me. That to be said, I mean, it is, all of my net worth is there, right? I haven't been right. And so my question is it failed? And it's hot, right? I'm very aware that fences are white hot. That's why I've had 60 calls without trying once. Right. So it's like, we did 50 last year. We'll do 90 this year, and I think we will comfortably. It'll be 150. I think it'll be 220 top line next year on improving margins. If you said what is that like? You could take it to the bank. Like you could almost take it to the bank. That's why I don't mind saying it on here. And if I F it up, I'm happy to get on here and be like, hey, I was wrong. Like, guess what? So my question would be timing, right? And I'm curious, for me and my people, let's say, let's just say 4 years ago, we were doing the 2.5 million on 30 million. Now I'm at this inflection point today and the market's hot, and who knows when they get bored and want to go do whatever they want to do whatever the next fad is for those guys. So I sit today at, if we started doing it, we'll be able to get, I would assume we would transact on this year's numbers. Last year's numbers are going to affect, and then I have a pretty healthy pipeline that we can demonstrate. But at what point in the process do I explore this and why? And you can tell me, don't do it, wait, or you should have done it last year. I'm just curious what you would say. Because I was exploring it for the last year, and every conversation made me more and more angry with these fucking nerds that think they can do it better and whatever else. So I'm like, you know what? I am just going to kick your ass. Like, I'm just going to beat you. So that's where I've landed. I'm like, so ESOP, keep it. Maybe I'll sell. I don't know. I don't mean to be closed-minded, but yeah, what's your advice?
Fair enough. Well, here's the other big thing that can cause a technical problem with the transaction. You have to have a desire to sell stock, right? Mm-hmm. And for whatever reason, I don't care what that reason is, but you have to have a desire to sell stock and have that stock be broadly held, right? And again, that's another, I would say, point number 2, where some people raise their hand and say, this ain't for me, is the broadly held thing, right? So you got to have some sense of belief that works, right, from a mindset perspective. So I think that's a big deal, and I'll answer your question, but I think that's where it starts, right? You have to have a desire to sell some stock. You don't have to have a desire for cash or liquidity, but you have to have a desire to reposition and sell a significant portion of your stock. It doesn't really work very well. I've seen them done for 5 or 10%. You don't get all the tax benefits, and it's not meaningful enough to your people to really move the needle, right? So you got to start thinking like 30, 40, 49%, where it starts to become a benefit that people can touch and feel, and it starts to, kind of impact your life. But a lot of it is just, how do you see the world? I think that's a huge element for someone like yourself, right? Because we actually run into this problem quite a bit where people come to us and say, I don't need any more money. Right? Okay, well, fine. That's okay. That's a problem we can solve for. What do you need to solve for, right? So what I'm hearing from you is it's not about getting the biggest check. It's about, there's a philosophical thing going on in your head about what is optimal. And, there's probably some legacy stuff built into that. I'm hearing, some sense of responsibility for your people. All those things, do kind of push you towards an ESOP because of the fact that it does accomplish a lot of those goals, right? So it's a wonderfully graceful way to exit a company, right? But again, do we want to exit, right? We don't have to. So some people look at this, like I said before, as a chips off the table transaction, and sometimes they don't even need the money, right? And that's fine too. There are charitable things you can do. There are, there's lots of things you can do with money, right? And it doesn't have to be spend it. There's, again, lots of utility there. But I think you have to start with what does it mean to you, and what would it mean to you, if you were to sell a significant portion of this company to anybody, right? So that's where it starts, is that willingness, desire to do that. So the financial arguments for the why of it, it's hard to make one right now given what you're telling me about your earnings, right? The argument I would make, right, is not about you. It's about your people, right? So if you think about what this means for your people in the next 10 years, right? So you're not an old guy. I don't know how old you are, but you're not old. You're a little older than you. I can tell that you got less gray.
36.
Okay.
I got time. Yeah, I got time in the tank.
You got a runway, right? So, part of it is, okay, well, what a lot of people do is they say, I'm going to do this ESOP and, I'm going to wait till I'm ready to retire, right? Which is fine. Again, nothing wrong with that. But the benefit of doing something sooner rather than later, it doesn't have to be this year or whenever you want to do it, is if you really believe this company is going to grow to $1 billion or somewhere in that range in value, you're going to create a tremendous amount of wealth for your people by doing it now, as opposed to waiting until you're done and then letting them figure out what comes next, right? So I've seen people that have done it just for that reason, because we feel like we need to get equity in the hands of our people so that they can come along for the ride too, right? Very common approach. You see this with Silicon Valley companies, for example, where everybody's got RSUs and, or some kind of pre-IPO stock. There's going to be a lot of new, billionaires and millionaires out of the SpaceX thing, for example, right? So very common, right? And I think probably critical to your trajectory to get to $1 billion is going to be not just keeping your people happy, but adding some new people, I would think, right? That's probably a fair assumption.
Yeah.
All right. So one of the paths to getting there is a lot of talent acquisition. Well, this is a differentiating factor, right? You come to work here, we're going to pay you well, right? And I'm assuming you pay well. But not only are we going to pay you well, but you're going to have an opportunity to build real wealth, so, in the company you work for through an ESOP. And that's a differentiating factor. Is it going to be the one reason why people come to work for you? Absolutely not. But will it make a difference, right? And will it allow you to do better at attracting and retaining the talent you'll need to get to the next level? 100%. It's a differentiator. So that's kind of the big reason why people in your situation would consider doing something like this. Not because, there's a lot of cash, because there would be a significant amount of cash that could come out of this, right? And it would be a change to your, kind of overall personal financial strategy and your family and all those things. But the biggest utility would be ultimately for you is, starting the kind of legacy, aspect of it, and maybe starting some form of transition, but ultimately building out that kind of long-term plan. And we have clients that ask us to build 15 and 20-year plans, and that sounds crazy, but people think like this. They, especially business owners, they tend to be long-term thinkers. They're planners. They want to look at scenarios. Think about kind of all the possibilities. So I think that's the reason, right? Is you've got a lot of people, you're going to need more people, so the ability to incentivize people the right way and get them all swimming in the same direction, that's your carrot.
And I guess I didn't do it. Yeah, it's all for the people. Like the only reason we're having this, I mean, that is my decision. Is what do I believe is best for my people, both now and in the future. Like that's my job. Like to me, is to take care of them, and that's the only reason. Yeah. So that to say, on the percentages, like, is there the mechanism, right? So like, let's say we forfeit control. Let's say we trust that. What is the mean? Like you see, the Dave Portnoy is my favorite story, and I think it just happened again somewhere where private equity came, bought them, did their thing, jacked
You
it
bought
up.
it back for $1, right? Didn't
Yeah.
you? Barstool.
What happens if, or what is the bedrock of like surrendering that control? So let's just say we do 100%, and I stand in a position, yeah, where do I ensure, like, have I forfeited? Obviously, I've forfeited control. So what are the mechanisms that you put in place to maintain the direction that, I don't want to say the ants are running the anthill or whatever, but if how do you keep it on the rails, I suppose? What's the
Excellent. Yeah, that's a great question, and something that I think that's very important to understand is governance in an ESOP setting, right? So how does it change? Well, first of all, trustee does not want to sit in your board, most likely. I've never seen a trustee actually sit on a board of a company, and they don't want to run your company, right? So what they want you to do is they want you to run your company, they want you to run your board, right? Because you're really good at it. I've noticed. You've done a really heck of a job building this company, right? So they're going to notice that too, and they're going to say, as long as he's willing to work and govern this thing, and whoever that group may be, we would like them to continue to do that. Right, so that's a huge difference between an ESOP and a sale to an outside entity is control, right? So let's start with a minority sale, selling less than 100%. So there are quite a few, I would say more than the majority of minority ESOPs, so there isn't even an outside director required on the board. It does happen, right? So especially with a larger, more complex company, but the most common approach there when it does happen is, let's just say, a 3-person board with 1 independent director. Right, so 2 of those 3 board seats you're going to have discretion over, and the third is going to be someone you nominate, and the trustee will have approval rights over. Right, so you'll nominate the slate. 2 of the 3 are discretionary. The third is going to be independent, and look at it like an opportunity. Right, add someone to your board that is going to help you get better. Right. Someone that you have a relationship with. Listen, as long as it's not your spouse, one of your kids, your accountant, your lawyer, or somebody that works for you. Again, the trustee's objective is to get a well-functioning board that's going to add value to the business, right? So from a standpoint of setting direction, the board has a lot of power in an ESOP setting, right? They're going to elect the executive officers, they're going to set comp for officers, they're going to make a lot of decisions around governance, right? So this is probably one of the biggest changes people don't talk about when they're doing ESOP transactions is, well, we got to live with this thing and we still have to govern this company going forward. Most companies have to get a little bit better about governance, right? We see very large companies that have no real board at all. Companies making $100 million in profit that don't have much of a governance structure, which is fine as long as you don't have to answer to anybody. When you have a few hundred employees that are beneficiaries of retirement plans invested in your stock, it's just a little bit of a different, operating environment for the board to live in. So you do need to get a little bit better, and I'm assuming you need to get better. Maybe your board is already great, but
you're talking to it's one of one.
The one of one, okay. So you have to add 2, right? One could be anybody you want, right? And the third is going to have to be somebody that the trustee is going to have to approve. But again, think about it. Push comes to shove, 2 of the 3 board seats are in your control, right? Now, trustee again, their job is to watch the shop, right? Look out for the best interests of the employees. Make sure you're abiding by whatever you agreed to. Make sure you're doing your filings appropriately, doing your testing, and all the kind of actuarial work and the legal and tax filings. And then they want you to go grow the business. That's their objective. They're long-term buy and hold investors, and they're going to look out for the best interests of your employees who are incentivized to grow and, again, help the business get bigger and better.
That's great info. My people do listen to this. Don't get excited. We're not doing anything crazy. We're just exploring.
Right.
and I don't, would you, this is a task for me right now, is how do you set up an effective board? Most of the feedback I've heard is like, I don't want to set up a board that is a bureaucratic barrier to an efficiently
Absolutely.
well-run company. So I think of a productive board. Do you guys, is that, where does a man start? I'm just a posthole digger that managed to do something by accident that worked well, right? Like
Right.
what would your guidance be?
Yeah, I think first of all, talk to your network, right? I know you have a big voice on LinkedIn. Of see your content on. Maybe I'm just liking too many of your videos, but
Hey man, I appreciate the
hey,
support.
whatever. Any pub is good pub, right? But yeah, I mean, start with industry contacts, right? So people that you think highly of, right? Start asking, your friends and colleagues, have you, approached governance? Do you have a board? FMI regularly helps people with things like governance, right? So we have a whole group that, comes in post closing with ESOP companies to help them with setting up a board if they like it. So we have a slightly different approach to kind of getting people through an ESOP because it's very different than a third party sale where there's a very clear kind of mandate post closing in most cases. The ESOP is, we found this quite a bit where people do the transaction and they, for some reason, just assume everything's going to be different the next day. And they come to work and they're like, wait a minute, everything's the same. I just have more zeros in my bank account, right? So I still have to do succession, right? I've still got to do the hard people stuff, the board and all the things that come with really, for a lot of people, handing over the keys, right, are not financial, right? So I think the people stuff is something we spend a lot of time on because a lot of our clients come to us and say, yes, we want a transaction, but there's this other thing, right? Sometimes it's hand over the keys, sometimes it's, I have a next generation, sometimes it's family, whatever it may be, you got to solve for it.
And two other questions. So what is actually, and I'm sorry if you said this, FMI's role in the ESOP trend? Is it a facilitator? What is the actual?
Good question. So I'm going to try this for the first time, so bear with me. So
Nice.
I've been doing this for 26 years, right? Guys like me have been using sports analogies for like my entire life, right? So what do you get? Let me guess. I'm gonna give you a guess. One guess to figure out what people the sports analogy people use for the investment banker. One guess. It's the quarterback, right? Everybody knows the quarterback. Put the quarterback in. He distributes the ball, and that's the analogy, right? Well, no more am I the quarterback. I'm going to be your GC, right? So everybody in this industry knows the GC. So what do? They organize all the parts, all the trades, manage the budget, make sure that the thing gets done, and then when it gets done, they collect hopefully some profit, right? We're doing the same thing, right? So we facilitate the transaction, bring in all the parties, help you negotiate, help you raise the financing, really hold your hand through the entire transaction process from the very beginning, where it's, we don't know anything, but we know we need to do something, to all the way through to, if you want, hand over the keys.
Got it. Sorry about my family scene in the background.
No problem.
I guess I'm going to ask one pointed question that, knowing what you know, is it irresponsible? Is it irresponsible to not ESOP versus why third party transactions?
No, I don't think it's irresponsible. I think, look, there are lots. People view the world very differently, right? I'm a little older than you, but you see this in your life, right? You can look at the same thing as somebody else, and they think it's. You remember the whole green? What was it? The green and white dress that some people thought was purple, and on social media. Do you remember this a few years ago? Like, people can look at the same exact thing and have a completely different reaction, right? And that's okay, right? So I don't listen. We see very successful examples of private equity transactions, strategics, ESOPs, internal buyouts. Again, values and the way you look at the world are what really drive people to do things, not necessarily the biggest, just purely the biggest check and the most zeros in the offer.
Fair. I appreciate that answer. And then, is there any statistics, and I know you guys are a pseudo statistics company, is there any for so let's if we and I doubt it, I'd be shocked, this would be awesome, I would invest in finding this out, but if you have catastrophic success, you have just like, we're going to put this range of mediocre, nothing changed. It's null. We'll call it catastrophic success, null, and
Catastrophic
catastrophe.
failure, right?
Is that those statistics exist to do the side by side comparison? I'm like
That's
trying to look at a Ford truck and a GM right now. Like, is
There
that
is
data?
there are some metrics, right? And I did not publish them, and my boss may shoot me for using another firm's statistics to support our argument, but there's not been a lot of empirical research done on the success of ESOP companies versus non-ESOP companies, right? There is one that was published recently, last year, a company called Stout, which is a big financial advisory firm. They do a lot of valuation in the ESOP work. They took a sampling, and maybe not a sampling, maybe it's their entire portfolio of ESOP companies, which is hundreds. It's not thousands, but it's not a crazy sample size. I mean, the S&P is 500 companies, right? So bigger, yes, but still sample size, right? And they looked at performance versus the market, and there is some hard data. If you look at their piece, and I'll send it to you so you can look at it, but it's not 100 pages. It's not bad, I promise you that. But ESOP companies do better. That's what their report says. There are some that go very badly. There is some catastrophic failures. I will say that the reason why ESOP companies fail is not because they're an ESOP. It's because they were going to fail anyway, right? And we just were the catalyst. That's it, right? So, and companies that are super successful were probably going to be super successful whether they did an ESOP or not. But the ESOP can be a very meaningful tool to getting you to new heights in an organization because it will change behavior, right? But the big but is you got to tell people about it, right? You can't just say, hey, we did an ESOP and snap your fingers and all of a sudden you're doing 20% more EBITDA, right? That's not what happens, right? It's a process. You got to tell people about it, incorporate it into your ideology, put an employee-owned logo on your branding, just all of the things, and then it does pay off. There's no question about that. And ESOP companies do statistically perform better, lay off fewer people in downturns, weather the storm better. They think differently, they act differently, and they get better results. So the long story short is, yes, there is some empirical data that says ESOP companies tend to do better than other ownership structures.
I love it. Please do send. I'm not going to ask you to say the name again.
Yeah.
Let it slide. I didn't hear it, but okay. And I do want to give the floor to you before I let you go. I know we're coming up on time, so thank you for being here. But the thing that I did a poor job of, and I'm so nervous, so I need to say this again. If my people are listening, like, please, this is just an exploration for the sake of the global audience. Please. Like, I'm just waiting for one of my executives.
Right.
You guys stop talking on the podcast. People are asking when we're ESOP, but whatever. What does it mean for them though? So the day, let's say we do it, and the day, how does that look on their side? Just what does it more mean in their world?
Yeah, so really nothing changes, right? And that's a good thing in the short term, right? So the next day, you close your transaction, you hopefully do an announcement, and everybody looks at you funny and says, well, that sounds great, and everybody's clapping, so I guess I'm clapping too, right? So that happens quite a bit, right? Because most people, your rank of all that, they may have heard of an ESOP, but like, what does it really actually mean? Nothing, right? And then, a year goes by, they get their first statement, they got $5,000 in their ESOP account. So what, right? Well, what happens is that over time, that $5,000 becomes 50 and 100, and they're hearing in the background, hey, we're an ESOP, we're an employee-owned company, everybody gets stock. If you stick around, there's going to be a retirement benefit. And then it starts to become real, and all of a sudden, it's like you've got, rank and file people with hundreds of thousands of dollars of money they didn't have before, just because they came to work and did a good job, right? And that's where the change starts to really happen, right? So I would say what you got going for you is ESOPs are very common in this industry, but still, it's not widely known, and it's going to take some time to build that cultural advantage, but it will absolutely, with the right amount of effort and the right practices, make a huge difference for your people. And it's going to be hundreds of thousands, if not $1 million for lots of people that work for you. And again, the why of this for you is the ability to do that, right? To give people, and for some people, that in and of itself is enough, right? It's like, okay, maybe I don't need any more money, but I've got 100 or 200 or 300 people whose families could be permanently changed by selling some stock in my company that maybe I didn't feel like I really needed in the long run, right? So that's kind of the pickup, and it will make a material difference. Again, we're assuming the company succeeds and all those things, but you have the ability, and that's very powerful, right? Is to change a lot of lives.
And in there, he's just, and I'm sorry to do this. If you need to go,
No, I got
go.
time.
The let's just say I've been there for 10 years. No, let's say 5, and I got $50,000 in my ESOP account. Is that theirs when they leave, or they have to be there for a liquidity event, or how does that materially become theirs?
Yeah, it's a
Or
good
is that,
question. So
what do you do?
generally, it's a retirement benefit, and there are things like vesting, which means they got to stick around to get it, right? And there's something called share allocation, which I'm not going to bore you with at this point. If you get further down the line, I'll tell you all about it and see if you can stay awake during it. But there's a formula, right? So every year you make contributions to the ESOP, and then they release shares. So that net is we tell people it's about 7 to 10 years before anybody can get any meaningful benefit. But they're going to see it and it's going to start to accrue. It's just going to have a lot of hooks in it, right? Which is, I think, important, right? Because what we don't want to do is give everybody a big check and say, here's all your money, now please keep coming to work for us, right? So what we're trying to do is create that incentive to grow that nest egg and kind of grow as a collective. Right? I know that sounds bad, but there is a socialistic view on this thing, right? So over time they accrue benefit, and then when they reach an event, right, retirement, death, disability, things like that, they can do a rollover into an IRA, right? So the company has to buy that stock back from them at some point, and you have a good amount of control over what those events look like, right? So you would do a plan document design, which is going to be the governing document for the plan for the ESOP. Now there are limits, right? You can't just do whatever you want. But there's a lot of things you can do to customize the benefit to fit your people and incentivize people to perform the kinds of functions and the types of behaviors that you want. But absolutely, they're going to have cash and value accumulated in company stock. When they reach an event, again, typically retirement is the most common one. You're going to buy that stock back, and they can do a rollover if they want, or they can take the cash and pay the tax.
Understood. I have many more questions, but I'll keep you all night. So I appreciate you making the time. Is there anything that I didn't ask, we didn't talk about, that I should address when exploring this
I think this is a really good start. I tell you, man, my biggest challenge is getting this much information into someone's head before they start to glaze over and their eyes start watering a little bit. And I can kind of see that happening with you a little bit, but
No, I
um,
was with you. I was with you.
okay.
Yeah, and
No,
I'm the
it's
worst,
not. I
by the
think
way.
bite size. This is about an hour. I think that's a good length for first conversation, and I'm sure you'll have questions as we listen back to it. So give me a holler. I'm happy to talk through it more.
That's awesome. I'm gonna end the recording. So thank you for being here.